Welcome back on 爱搞钱的女子，我是令维。Your long wait will be rewarded. Today we're gonna talk about American stocks, and I have just the right guy here for you.
全美乃至全球的关注，也有专家指出，市场较量的最终结局可能没有明白。Short sellers they may be unpopular, but overall they're very good for the market.
看一下油价。
坊间接受记者采访的专家表示 ，oil prices are looking like the storage system is.
白银市场上，对此业内专家表示，预计白银市场不会。
专家指出，散户抱团 ，and they felt the big institutions were taking advantage of it.
结果，有专家认为
all these little guys were.
I actually received this question a lot. I want to know myself as well. As a professional who's been in this field for 30, 20 years?
20, I'm not that old.
How would you pick a stock? Where would you start? Let me guess.
What?
You would look at the political situation, government policy and economy. You would look at what the Fed say, or unemployment rate. Is that true?
First thing I do is ignore all of that, actually, because that's what most people look for. And to make money in the market, you have to do what people are not doing. You have to see what the market is missing. So when I buy a stock, I want to know what's the market missing. And most people bet on psychology. Instead, I bet on companies that add long-term economic value. So it sounds boring, but it works.
Sounds Warren Buffett.
It is Warren Buffett, yeah. But he says, beating the market is not about being smart. It's about having an emotional temperament that most people don't have.
Where would you start? The company? Fundamental analysis?
I have what I call the 3 M's that I look for in a company. Number one, first M is management. So I want a management has typically a lot of experience in the business. I like to see if they have insider ownership in the stock, and ideally they're rewarded for adding economic value. The second one is Moat, M-O-A-T. This is a Warren Buffett word. A moat is like the water around a castle. It's the protected economic position.
This word, you hear it every day, every hour, every second in Chinese. It's called 护城河. Everyone is talking about it.
And for good reason they're talking about it, right? Because a moat lets a company charge more money than it could otherwise. Because if it doesn't have a moat, then the competitors are going to come in and just push it out. So you want an economic moat, and you can measure the moat in what's called return on invested capital. That's my favorite metric. And the third M is simply money situation. When companies fail, when companies have problems, it's typically because they run out of money. They can't pay their debt, they don't have enough profit. So I look at the cash, I look at the debt, and I look at the economic value added by the company, how much profit we have. We forget, as equity investors, we don't own the revenue of a company, we don't own the gross margin, we don't own the operating income, we own the net profit. So watch that number before anything else.
That means you spend a lot of time on financials.
I do, and it sounds boring, but I'll tell you this, if you gave me a stock screener, or if you just told me a stock's gonna have, I don't know, return on equity above 12%, return on invested capital above 10%, insider ownership above 3%, growing earnings, things like that, I'd be a lot closer to liking that company because statistically I have 40 or 50 years of academic research on my side. Those companies tend to outperform.
Now that you own the stock,
Yeah.
what is your exit plan?
My exit plan. So, some people get a prenuptial agreement when they get married, some don't. But it's like basically what happens if you break up. You should do that when you buy a stock. So when you buy a stock, write down why you're buying it and what would have to happen when you sell it, and keep yourself honest. It's simply a reverse of why you buy. Many people lose money because they don't notice what's called thesis creep. Something changes with the company, they say, I'll just keep holding, Or they want to break even. They lose money. They say, I'm just going to wait till it comes back up. But a UCLA study, yeah, I know, right? I think more money has been lost that way in investing than any other way.
Okay.
A study by UCLA found that the pain of a loss to human beings is 2 to 3 times greater than the pleasure of an equivalent gain. So your own psychology is working against you.
That's exactly the psychology we learn in psych class. So when you buy a stock, you tend to hold it for like a very, very long time, unless something is changing. But the thing is, for people like Elon Musk, like he says exactly same thing as 20 years ago if you go check his interview. Tesla doesn't change. Tesla hold his mission for 10 years, even the entire market is looking down. You don't sell Tesla.
Jeff Bezos is the same way. You look at Amazon's letters to shareholders from 20 years ago, he's been saying the same thing, but that's exactly what you want. at least for me, as a lazy investor, I want to buy and not have to sell. I want a company that I can hold for 5 years, 10 years, 15, 20 years. So I like that consistency. That's exactly what I want. And it's not that hard. It's just a matter of sitting still like a potato and doing nothing. But as humans, we have activity bias. We want to do something. And the information climate that we have in today's investing world works against our psychology massively because there's so much information coming at us and it makes us want to react. It makes us want to do something, take action, but usually, almost all the time, not trading is the best thing.
Do you read a lot of information in that sense? Because if you don't read them, you won't act on them.
I don't have any stock checking app. I don't have a TV. I don't actually check my stocks every day or every even week because information in my mind is something to be avoided. I check my portfolio balance maybe 3 times a year.
Yours or your clients?
Mine.
Okay, so you don't do that to your clients, right?
Yeah, well, I mean, my clients have their own stuff. I mean, we just provide research essentially. So if they want to act on that research, great, and that's their business.
I see.
But even then, I would tell them, and in the US, when I advised people for 12 years, I said the same thing. Don't check your stocks too frequently. You're messing up the feedback loop when you do that. If you're investing for a 5 or a 10-year period, it doesn't make sense to check your stocks every day, does it?
But the thing is, if you look at those professionals, they read stuff like Bloomberg or Wind every day. That's the tools designed for them.
It's not a tool, it's a drug. It's a drug. You know, they want this information, they feel good. The human mind, we crave this illusion of certainty. But it's just an illusion, it's not a reality. Taking in more information does not make us better investors. Focus on the why rather than the what. I've trained literally dozens and dozens of analysts, and one of the most common mistakes is they'll just show what a company does. Here, a company does this, that's why we should buy it. No. I don't care about that. That's commodity information. I want to know what the market is missing. I want to know why I should buy this stock.
But it's 3 times a year. That means you don't look at it at all.
You know, I wouldn't say you should just totally close your mind to it, but most people check way too frequently. You don't need to check every day. You don't need to check every week unless you're day trading.
I grew up day trading. I still hold a small amount of money for day trading. It's part of the Robinhood generation in me. But I have most of my money in a long-term portfolio that I don't frequently do anything about.
And to be fair to you, we've had a good environment for day trading. We've had a great bull market, so you might be a little smarter than I am in that regard.
I do realize every professional said no, they warn me about this day trading habit. And the tax really work against it.
Yeah. According to one study, 90% of day traders lose money.
I understand. But if it's a bull market, everyone makes money. But I realized that my day trading account makes a lot less in the long run. What would you recommend for people to read? They still need information.
Obviously, well, I'm biased, right? So, we have lots of research on our website, or our platform, I should say, that I think is useful for investors. But any of the commodity information you can get at most of the broker websites or any of the major platforms. That's a great place to start. I think the investor relations sections of company websites are underutilized. People don't realize there's actually a lot of good information there. In their PowerPoints, they'll tend to present the positive stuff, but they're generally not going to lie to you unless it's a fraud company. So I would search that. And if you're a professional investor or maybe a serious enough retail investor, you can even call the investor relations department. Make sure you have a serious question, otherwise they'll blow you off. But they'll help you. You know, they want you to buy their stock. They want you to understand the company.
You're talking about calling them during conference call?
The conference calls are usually open only to the professional analysts, but just during the daytime. And if it's a simple question, make sure you have a clear question. They'll get back to you. You know, people need to understand the companies they're buying more than they do. Companies should not be like gambling chips or in a casino. That doesn't help the economy either, by the way. When people just buy and sell like it's a poker or blackjack, that's not contributing to the economy. When you're avoiding the bad companies and channeling money to the good companies, you're not just helping yourself, you're actually helping the economy overall to get better. You're cleaning out the bad and rewarding the good.
That sounds like something really big. When I buy stocks, I'm contributing to the world economy?
You are. I think you are already, actually.
I'm going to sear the sushi. Speaking of the moat, every time I pick a stock and present it to the manager, the very first question he would always ask is, what is the moat? I've heard it so many times that it's now stuck in my head for the rest of my life.
That's a good thing to stick in your head, Ashley.
Zoom went up crazily last year because of the COVID-19. But my manager was concerned about it, saying it doesn't have a strong moat. Whereas if you go on YouTube, a lot of YouTubers, they were crazy about Zoom last year, right? They were like, this is the winner of the pandemic. Let's buy it. I'm buying it. You should buy it. Barely of them mentioned the moat of the company.
Well,
do you think
I think people are confusing moat with first mover advantage, right? And companies get a head start on something or get a benefit from a pandemic, for example, but that's not necessarily a lasting moat. There are many companies like in the US, MySpace, instead of Facebook, it was the first social media. They were dominant. Everybody thought they would be the winner. Nobody knows about them now, right? There are many companies like that that went first but didn't necessarily have a moat. I'm not saying Zoom doesn't have a moat. Maybe they do. Maybe they will still win. But just because you're first doesn't mean you're going to be the ultimate winner.
I have a stock in mind that connects to what you just said. It's called Yesen. It's a Chinese concept stock. The company went public in 4 years because they caught the wave of social media. I've seen a lot of professional investors state that Yesen only have first mover advantage, but they have no moat.
It can happen, and sometimes companies do start that way, but the smart ones build the moat as fast as they can. Moat can be regulatory, moat can be with brand, moat can be, so they're probably trying to build their brand as best they can. There are different ways to build that moat.
Coca-Cola has a strong moat.
Because super strong moat.
Not because they have the best soda drink
They sell
ever.
nothing. It costs nothing almost to make the sugar water, right? And Pepsi even beats Coke in a taste test. But they have such a strong brand, that's what they keep, there's nothing special about the Coke formula, really. People think there is, there's not. People can't even distinguish between mini sodas on a blind taste test. But they don't sell Coke. Their brand is to make Coke cool. That's their business. Nike's job, for example, is not to make shoes. Nike's job is to make shoes cool. That's the moat.
Talk about Zoom. There's no moat right after they released their financials. And they have a really good financials at that quarter, by the way. They announced this, their business plans by saying that they're moving into a work email market. Then you see the stock dropped like more than 100 in a couple of days. You got Gmail, you got Outlook out there in the market.
Right. Exactly right.
You're saying you're competing against Microsoft and Google?
That's thesis creep, getting into a super competitive industry, and that's exactly the thing you want to watch for if you're a shareholder, because just because they can succeed in one thing, then you think, okay, well, we've kind of capped out this, what do we do next? And usually it doesn't go as well. A negative moat, the business is diluting its moat by expanding into an area that is just not strong in. We see this all the time. Companies max out their main area, think, okay, well, we got all this money, we're doing well. What else can we get into? Almost always, the incremental returns on that invested capital is going to be lower than the incremental returns on the initial project.
That's when you're going to sell.
Exactly, right?
Do you like Elon Musk a lot? Because I adore him.
I have mixed feelings. I think he's obviously fantastic at what he does. Everybody doubts him, but he still keeps succeeding. He does cut some ethical corners and over-promises sometimes, but I think that's just kind of part of who he is. And I got to give credit. There have been detractors for the longest time. Everybody's always hating Elon Musk, criticizing Elon Musk. But look, he still succeeds. He still mostly does what he says he's going to do. Maybe not always, but mostly.
All the professional investors I've met have a list of reasons why you shouldn't buy Tesla.
Yeah, on a traditional valuation, way of looking, it looks crazy, right? But that's the thing about valuation. It's dangerous because it's kind of based on mean reversion, going back to the average. So really exceptional companies like Tesla or like Microsoft in the late 1980s or Apple in the 1990s, they have growth trajectories that are so fast, so for so long in the future, it would look crazy to model that on a spreadsheet. You could, but you just feel super weird. So those traditional investors almost always miss the best growth stories. That's the downside.
That's what Kathy would say. She doesn't even use the PE to look at anything.
There's some truth to that. You're not going to find the really best stocks by looking at PE. You know, they probably don't even have E. She can't use PE, I bet, a lot of times because they don't have any earnings. So you know, she's right about that. But she's also playing a hard game. In the U.S. in the 1930s, there were 236 car companies. Now there are what? 4, maybe there are more now because of EVs. But in the 1990s, we had hundreds of e-commerce platforms. Now we have Amazon and eBay, right? We had 45,000 cryptocurrencies a couple of years ago. Now we've just got a smaller number. So every big industry starts with all these entrants and only a few survive. So if you can pick those survivors, if Cathie Wood can do that, she's going to be awesome. And she's done that so far, but it's very hard to...
There's no way you pick like every survivor because the author is so little.
Exactly. It's basically about a histogram. Histogram is like a chart of like all the bars, right? So how many losers do you buy for every one winner? You know, it's like venture capital investing. They invest in 10 deals, most will lose money, 1 or 2 make it big.
You buy everything in the industry. As long as one succeeds, they succeed.
Oh, if it succeeds big enough, yeah. Sometimes though it doesn't work. So that's the downside, that's the dark side, and that's the gamble of growth investing.
Do you like Cathie Wood? Because I personally, I like her analysis and I like stocks she pick. I think she's super smart and I think she's professional, but I don't think I like the way she markets herself.
Yeah, I get that feeling.
As an ETF investor.
And a lot of the people in her funds are probably not sophisticated investors. For example, they launching a space ETF, but there's not enough space stocks to invest in. So she's picked companies like John Deere, which is like a tractor company. I mean, maybe they have some like tiny portion of their business dedicated to space, but it's just not ready for an ETF. But I think she's trying to, English would say, make hay while the sun is shining. She's famous now, she's got good returns, she's in the spotlight. She's trying to capitalize on that and start as many ETFs as she can. I think she's going too far.
She's so popular on Wall Street Bet.
Well, she's doing great because it's been a great market for growth investors, right? But it won't always be.
I always take a deep look at the companies she picks. She picks very good companies like Roku and Square. Those are great companies to look at. But I would never put her ETF as a major share of my portfolio.
I think that's smart. Yeah, I would do the same thing.
What would you hold?
I'm super boring, believe it or not. I have a lot of boring index ETFs from Vanguard because it has a very low fee structure. And then I just add individual stocks on top of those index ETFs when I have a strong conviction about something. So I bought some gene editing companies like DNA editing.
That's pretty Cathie Wood.
Yeah, you know, I do have some growth stocks. Yeah, you're right. But, you know, I also like boring companies, like water and sewage companies I like. I used to invest in a coffin company. But, I mean, think about it. Nobody's going to stop flushing their toilet in a recession. So when you buy a sewage company, you're not going to make a lot of money, but it's going to be pretty steady.
It's a cash cow.
Yeah, it's just like food. You don't eat all sugar, right? You can have dessert on top, but you want to have some broccoli, some lean meats, things like that as your base.
Does that count as a dividend stock?
Most of those are dividend stocks, the stable, steady companies. It's just, I ran a dividend service for 10 years in the US and for 5 years in London, so dividends are kind of my home field. Yeah, and there's a lot of statistical evidence that dividend stocks outperform non-dividend stocks. And it's not just because of the dividend, it's just because of the overall economic characteristics.
Not last year, right?
No, they've been terrible last year. You're right. Now it's been the worst time to be a dividend investor, but it won't always be.
Finished. Thank you, James. Let's have this.
Awesome.